You're listening to The Preferred Way, a retirement podcast brought to you by Preferred Trust Company, the preferred custodian for all alternative investments.
Hello and welcome to The Preferred Way. I love when we have CPAs on. You know why? Because I'm not licensed to talk about it, but Larry is. Welcome, Larry, to the show. Why don't you introduce yourself, where you're from, and who do you work for?
Thank you. Thank you. Larry Pendleton, the investor CPA based out of Norfolk, Virginia. We have our tax consulting firm, PC Financial Services, as well as our real estate company, CP Realty, that we run and operate.
How long you been in business?
We've been running the tax business for nearly 2 decades and the real estate business for a little close to a decade now.
Wow. Long time, huh?
Yeah, yeah. Last seen those days.
Well, today we're gonna talk about a variety of different things, if you're okay with it.
Oh man, we're ready to roll this
You're
off.
good. You're good. All right. Well, really wanted to focus a little bit on our younger generation. It's been something that Preferred Trust has really been focused on. I don't know what your population of your demographic are of your clients, but are you starting to see more younger and younger generation needing your services or wanting your services?
I see more. I guess they were talking about in the 20 age, like 20.
Yeah.
They're kind of like poking around and seeing like, hey, what they need to kind of get set up. A lot of them are just kind of just hustling in the grind, trying to learn what they can and get things.
Yeah.
But they are starting to kind of ask questions about like, when do I need retirement accounts or what type of investments that I need to really be focusing on going forward. So it's starting to kind of see more of that this past I'll probably say past 2, 3 years.
Yeah, we've seen a lot more of it too. I think the younger generation is making more money than they have ever made in the past, whether that be in alternative investments or I know I know here there have been a lot of younger individuals investing with their Roth IRAs in digital currency.
Mm,
Um, I see them turning millions, and it's like, wow, like
yeah.
these younger generation, what they were willing to do that maybe you and I weren't at the time. I'm like, holy cow, they're willing to take a little bit more risk. And sometimes that's because, they're not buying, they're not buying homes. They're renting and they're utilizing their funds for other things, adventures, a lot more in investing. Really surprised when you see the statistics that are out there, and it's just kind of interesting. So I wasn't sure how much of the younger generation was really needing or wanting your services.
Yeah, I
But
mean, I started seeing more of them like kind of seeing like, hey, yeah, this whole Social Security thing may or may not be around whatever the retirement age is once they get to that point, in that aspect of like, hey, like working for someone for 40 plus years just to get a gold,
yeah,
that's not an appeal. And then like I mean, some just they kind of question the stock market or just want to have a little
yeah.
control, especially after they kind of seen what's been happening over the past few years.
Yeah. And that's what kind of leads them into these alternatives and starting their own business. Like they don't want to, they may not want to work for anybody else, which is phenomenal, right? To come off of, either out of college or right out of high school, and they're starting their own businesses. And so I could see where your services become more and more relevant to them, because of the unknown, because of the taxes, because of the opportunity to write things off, with this younger generation. And
Yeah.
so I think, as the years continue to progress, I think you and I will see that more and more in the industries that we're working in. I know that we are seeing a younger generation starting to open up Roth IRAs. We're kind of on the tail end of the generations where traditional IRAs were the only option.
Mhm.
And, when the whole Roth IRA thing got brought into perspective, I think as they become educated about it, they become more interested in like, wait, I don't have to pay tax on that, especially when they start filing their first decent sized tax returns, and paying on that. I'm
Right.
sure you're helping them though, pay as little as legally possible. Probably one of your mindsets and your goals in all of this. Because before we go into the whole self-directed IRA and I ask you a bunch of questions,
Mhm.
There's obviously been a very recent interaction that has occurred, two of them really, right? The one big beautiful bill, I'm just going to say it. And, just the other day, President Trump um, signed an executive order to allow 401k investors to access alternative assets. Two very big components that affect both my world and yours. So I'm going to ask you just a little bit on the big beautiful bill. How
Um,
has that? How will that benefit from a tax perspective? I know there was some really kind of interesting things that may come of that. Anything that maybe the younger generation should consider or look at?
no, it definitely has a lot of tax benefits when used appropriately. It's almost a extension of the Tax Cuts and Jobs Act back in 2017. So you see a lot of extensions of those
Yeah,
that were set to phase out this year, next year in 2027. Like prime example is the 100% bonus appreciation. So you'll
yeah,
see a lot of people now. A lot of people kind of move towards to the short term rentals and working that loophole strategy.
yeah,
Younger generation where they don't have a full-time job per se, like you can still qualify for a real estate professional and not worry about the peaks and valleys of the seasons when it comes to short-term rentals, and still invest in long-term rentals and benefit from it, from there as well. So that was a huge extension there, as well as the salt tax and that state and local tax going from 10,000 to 40,000, especially in those states
yeah,
where it was already difficult. It was difficult seeing that 10,000 cap if, if you're having a lot of
mhm,
property taxes, um,
yeah,
and then kind of leveraging like you may not have to do the whole pass through entity strategy with that, and just rely on that 40,000 to be able to maximize your itemized deductions there.
yeah,
And for society as a whole, what people really don't realize is that some of those like just the individual tax brackets were about to go up to
yeah,
4%, depending on which bracket that you kind of average out into. So it kind of compressed and kept a lot of the tax brackets kind of where they are now.
yeah,
So like I said, there were some huge benefits. Obviously, they try to do the $10,000 with the car interest notes and give a shot in the arm in the American car industry. So so I get a
yeah,
lot of people deflate when I say it has to be American assembled. So so like hey, and it's all like personal. It's only for a personal vehicle. So it's like, hey, you may just want to still stick with a business vehicle because you get still a bigger tax benefit there. So it's like it tried to address different areas of like business owners and non-business owners, especially with the $25,000 and no tax and no tips and overtime and the 6,000
yeah,
uh, senior deduction to help come back with the Social Security. So like there was a lot of different tax benefits as a whole for all
yeah.
ages, but it's definitely
All
with
ages.
the younger generation as well.
Yeah. It's been pretty crazy. I'm sure on the tax front, it's like, I mean, there was some significant wins in there.
Yeah.
I'm sure for your clients, that you'll be able to uh,
Yeah.
pass on the good news to them. Let's just say here the next couple months. So
Doing the world tour now, and it says doing a lot of just consultation with clients now, especially those who have been kind of sitting on the sideline, like waiting to
yeah,
wire stuff. And I typically tell them don't let the tax tail wag the dog, but they do find that opportunity to go ahead and buy something. Just want to make
yeah,
sure it's a good investment before you just
yeah.
jump out there because of the tax benefits.
Yep. Well, it certainly doesn't hurt the economy when there are some tax benefits out there. And there's you never know. You never know when's a good time, and we change presidents, and then it swings a different direction, right? So
Yep,
take advantage of it while it lasts. Who knows if it will go into the foreseeable future or not? But hey, you know what? While it's there, take advantage of it for sure.
exactly.
And then it kind of leads us into the next discussion, which is really putting these alternatives into 401k plans, and the impacts of that. And, I think something that's kind of important to consider is, this is an order to really investigate it before it's like put into place. I also read a report that Empower is going to be offering alternative investments in their 401k plans. And I know here with our employees, we actually just recently moved over to Empower with our 401k plan, and we tried to get them to incorporate the alternative assets, but they told us our firm didn't have enough total assets to participate. So I'm sure
Mhm.
there's going to be some, there's going to be some thresholds there, especially as some of these big boxes, financial institutions start dipping their toe into the alternative side of things and realize how much damn work it is. I'm just going to be honest. It's a lot of work. But you know what? I definitely think it's something that should be available to everybody. But I
Right.
think it's important for people to realize it's available now. It's not that it's going to be available, it's available right now. And, there are firms like, Preferred Trust that offers the ability for any age to participate in alternative assets, as well as, there's a lot of investment sponsors out there that are probably laughing a little bit at this, going, well, I have young investors right now. I have all kinds of investors right now. They don't have to be accredited. They don't have to use a 401k plan. And, to be able to participate as an investment sponsor of an alternative asset in a 401k plan, well, that's going to be interesting too,
Yeah.
because they're only going to accept the elite of the elite, and that's going to leave out the 99% of the others.
Exactly.
So it is going to be very interesting to see how it all plays out, but definitely exciting times, because anytime there is positive change and opening up options for people to invest, that have some tax benefit associated with it, it's definitely going to be talked about for sure.
Yeah, and I
So,
think the thing was really hopeful. A lot of clarity is like, okay, what control does the employee have in that case? Because I said a lot of my clients who are just capital raisers for their own deals, they're working with people who, like I say, have their own self-directed IRAs, or they have their own separate business. They have a solo 401k, self-directed as well. Whereas, okay, if you're working with an employee who has an employer sponsor, they just can't take the money and self-direct that. So
yes.
it's curious to see if that's going to be part of it. Or does it empower the employee at all to control their own retirement account and invest in that stuff, or is it always going to be going through the custodians as a whole, and like what's presented to that custodian that then presented to the company? So it's just
Yeah.
a lot more understanding and research that's about to be done to see where they want to
Yeah.
put this at.
Well, one thing is for sure, no custodian's going to hold the liability of offering an investment, right? Because
Hmm.
then they have to get the employer to sign off on the fact that they're holding a liability to
Right.
offer it to their employees. And then you have to get the employee to sign off on the fact
Yeah.
that they're taking an additional risk than they would have otherwise by somebody who is managing these, suite of mutual funds that are being offered in these 2040, 2050 plans. So there's definitely a lot of work.
Yeah.
You can sign an order, but there's a lot of work that's going to have to go into it, not only from a legislative perspective, but a large corporate perspective, down to the employer perspective, and then on to the employee. So this is a long way from being, let's just turn on the faucet for sure.
Oh yeah.
Yeah, it's going to
Attorneys
take
get
some.
involved.
Yeah,
Once attorneys get
it's
involved, it's going to take even longer because everyone's going to have CYA at that point.
absolutely, absolutely. And something that's really important from a self-directed custodian standpoint is, right now we don't take on any fiduciary responsibility. It's a self-directed IRA for a reason. It allows people the option to choose what they want to invest in, right?
Mhm.
It gives them the ability to do their own due diligence without somebody else saying, "Here's the suite of products you have to choose from." And
Mhm.
that's the whole point behind a self-directed IRA is you go find something that you are passionate about, that you've researched, that you've done the due diligence. Maybe it's, somebody, friends, family are investing in it and they've been successful in doing so. That particular investment isn't just going to be available in your 401k plan.
Right.
You're
Exactly.
going to snap your fingers and be able to use it. And if you are, then you're going to have to move some funds out of your 401k plan to another custodian, which puts you in the same boat of a self-directed custodian. So this is going to be really interesting to see how it all plays out. But I'm here for the ride, right? I mean,
Yeah.
same thing with the big, beautiful bill. You're like, what tax benefits are we going to be able to offer?
Exactly. The
Exactly.
right way.
Yeah. All right. Well, let's get into a couple of questions. Maybe on the self-directed side, and then I'm gonna go the other direction on you just to tap into your expertise. But
Mhm.
why do you think it's important for this next generation to understand the self-directed IRA perspective or IRAs in general? Like, when you have a younger client and they have the option of, paying Uncle Sam or maybe reducing their income down and contributing to an IRA. Like, what is important for this next generation to know as they kind of lean into their careers and maybe alternative investments?
I mean, one being that you're in your high income earning phase now. And
Yeah.
at some point down the road, you don't want to have to be in the grind all the time of being a high income earner. If you're just like say if it's all based on your intellectual knowledge or physical
Yeah.
capabilities, where it's like, okay, that's where you having that nest egg on the back end comes from. But the self-directing, that's what just the IRA in particular, and retirement accounts in particular. But with the self-directing part, it's taking control of like, hey, like I I want to kind of invest my money elsewhere outside of just stocks and bonds. Nothing wrong with stocks and bonds. I still want to have some money there, but I do want to have money elsewhere. Like I want to get more into crypto. I do want to have my self-directed IRA on some real estate as well, or invest in someone's startup that I truly want to support. Uh, um, from a passive standpoint there. So it's just
Yeah.
understanding that like, hey, at some point you're gonna need that nest egg down the road. And while you're at it, why not uh, let other avenues grow it where it doesn't really actively involve you, but you know, like and trust the operator and
Yeah.
who's bringing it to you.
Yeah. Absolutely. And it really kind of plays into their long-term financial strategy too.
Mhm.
So, I don't know if you do this or not. So I'm gonna ask the question. Maybe this is a loaded one. For the younger generation, do you suggest traditional or Roth and why?
You always give me the depends question.
I know, because I'm,
Yeah, so
it's
like the
it's
aspect
I'm just
of because
curious.
yeah, because the aspect of like IRAs in general, we know $7,000 a max.
Yeah.
So if you're at the highest tax bracket, that $7,000, that's only going to give you about $3,000 of actual tax savings. So like,
Yeah.
okay, you get something there, but as you know, with most tax strategies, it's you will have 3 or 4 machetes and a
Yeah.
ton of steak knives, but you're going to stockpile all of them to actually make some big cuts along the way. So it's like, hey, well, if your income is under a certain, especially if you're under the threshold that will allow you to invest into a Roth, why not jump it in there unless you really need the tax savings, and then we will still have the option of moving it or doing the traditional as well. So it's
Yeah.
like, it's really kind of based on like where they are from an income perspective. Okay, if they're
Yeah.
that 160 if they're single, like the 161,000, to get the full contribution. And if you don't need the tax deductions, let's just go ahead and dump it into a Roth and not have to worry about that. Because if it's in the traditional, we're gonna have to plan on getting that moved into
Yeah.
it eventually. But we have to find another
Mhm.
year where your income is low or you may have a loss because
Yeah.
of some investments there. So it's really having that deep discussion with them in order to get understanding where they are now and really kind of help drive them. So like I hate to say it depends, but like that's part. I just want to kind of give
It
more of
does.
like how that conversations go from my perspective.
Well, I'm telling you what, I'm using machetes and steak knives as a quote. So thank you for that one.
Uh,
That's something I will be using. Uh, wow,
yeah,
that
give,
was
give,
good.
me, yeah, give me no credit. Just take it all for yourself.
No, 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 no. I can assure you that will be on social media later. Machetes and steak knives as you're determining whether you contribute to a traditional or a Roth IRA. Um, Definitely. I mean, and you're right. I mean, it just and they could do both too.
Yeah,
That's one huge misconception. We talked about that the last time we talked is that, it is $7,000. That's correct. But it could be $7,000 for a traditional and it could be $7,000 for a Roth.
Yeah.
Now you're talking decent numbers. And if you're a younger generation and you're making decent money, you know, there's a few things that we could do without. the Let's just say the luxury items that we could do without, because what those small contributions can mean over an extended period of time is insane. And I don't know if I told you this story, Larry, but when my son graduated from high school, he worked his senior year. I know some people are like, oh, he probably didn't need to, whatever. No, that damn kid worked, because it was important for me as a graduation gift to him to put $7,000 into a Roth IRA. But the only way I could do that is if he had earned income.
Hmm.
And so he had to work. So that kid had to work. And that was my gift to him. He didn't know it at the time, right? He had to work either way. But that was my gift to him, and a calculated spreadsheet of what that $7,000 will look like by the time he's 60 years old in a Roth IRA. And what that meant to him over that period of time, investing in, even if you just left in an S&P, I don't care, 10% year over year. I mean, you're talking $1 million from
Yeah.
one contribution. So for the younger generation to think that that isn't a possibility, I'm here to tell you it is a tried and true possibility. And it's one of the greatest gifts that you can give to yourself as a younger person, to set yourself up for success. Now, $1 million when you're 65 ain't gonna be enough.
Right.
It's just not. And so imagine if you made that contribution every year. And it seems like such a small amount, but that compounding factor is crazy, crazy.
Yeah.
And stuff that we should be teaching to the younger generation.
Exactly.
Anybody who's in this industry, you, me, all of us, we should all be talking about it. But let's talk about some of the pitfalls, because as we're starting off into our investment journey in life and retirement journey in life, what are some of the common mistakes that you have seen some of the younger generation make when using a self-directed IRA, or you know make it tax related? Like, what are they missing? What are the things that they just commonly miss that you're like, oh, I wish I could teach that to the younger generation?
Just understanding that you can't get into the self dealing at that point. Like that's really the
Yeah.
concept. There's like you are truly you like you cannot personally benefit from an income standpoint, or from a direct tax standpoint, where like your tax benefit is, if it's traditional contribution, you got tax free growth, but that all stays into the account itself.
Yeah.
If you, even if you acquire a rental property within your retirement account, like all that's
Yeah.
in there, and they're just, and you can't manage the property, you gotta get someone else, and the retirement account is paying all that. So it's really just kind of helping them understand, like, you got to have your kind of have your system and structure in place of how you're going to operate your assets, or how you're going to manage your assets from from
Mhm.
afar, because you can definitely put the risk of having your IRA just completely blown up and tax
Yeah.
everything in there, if not done correctly, or if you are self dealing there. So that's kind of the one biggest pitfall that
Yeah.
I've seen with it, as well as just kind of getting trapped into running businesses within the retirement,
Yeah.
getting hit with the UBIT tax, unrelated
Yeah.
income tax there. Whereas, okay, like that's like you can't, you can loan to someone else's business, but you can't sit there and run a flipping business out of your own flipping business out of your retirement account, because you will be subject to additional taxes that you was not really expecting, because you thought it was just all going to be tax free at that point, and it's not when it comes to those type of activities.
Yeah, so true. And you're right. I think as we look at like the fix and flip, that's probably the biggest hurdle and issue that we have, because when you're talking about self-dealing, just so everybody understands, like, you can't be your own real estate agent and profit from it. You
Mhm.
can't be your own plumber because you're profiting from your rents. You can't be, so it's those little things where you're like, "Oh, I'll just go over there and paint the wall. I'll just go over there and fix the toilet."
Mhm.
And you can't do that. And it's kind of an interesting struggle because it's like, well, then Larry, should I even put my fix and flip in my IRA, or should I just keep it out? Are there better tax consequences or tax benefits keeping it out?
Yeah, the benefit is keeping it out your fix and flip, because like I said that UBIT tax is actually a lot higher than you just reporting it, and you can have additional tax strategies going within there to to reduce your taxes from the personal standpoint, especially in
Yeah.
structures and all that as well. So it's best to keep your fix and flip business, your wholesale business, your real estate agency businesses outside of your S corp, and then just really funded by investing to somebody else's business, and kind of go
Yeah.
or just hold your passive assets in there.
Yeah. And there's some investments that are, benefit to have it in a self-directed IRA, and there's some that I firmly agree are a benefit to have out.
Yeah.
And, I definitely know both sides of that fence myself just from, passively investing. What do you think is maybe the number one asset you would say keep it out of an IRA? Because there's such tremendous tax benefits outside a self-directed IRA.
Rental real estate, whether short term, mid term, long term, like if you really are trying to like leverage the tax losses, especially as we talked about the OBBB or
Yeah.
100% bonus appreciation. So like
Yeah.
if you can able to qualify as a real estate professional or get the short term rental loophole underneath your belt, it's best to keep those long term holding assets outside because you'll have some huge losses to help offset
Yeah.
your taxable
Fair
income.
game. Yeah, absolutely. What about oil and gas? What about energy?
Kind of same thing where you have that working interest that allows you to use the losses to offset other income. So like if your
Yeah.
goal is to like, hey, I'm not trying to be a landlord. I just trying to get some losses, and I found the very few trusted operators out there in the oil and gas space that's raising funds. I put 50,000 there. Like, okay, we can then use those losses once again, similar to the rental real estate, to offset your other income. So like those are kind of like the two big ones there. Was like, yeah, we can leave those out if you have like say, if you don't have any other realm of like creating any tax losses or to reduce your tax liability.
Yeah. Okay. That's helpful. Those are probably the two bigger ones. Depends on how you use them both. I can see both sides of that too, because if you're, I don't want to say, I'll use it, joint venturing with somebody else, and there's four of you and you're starting to buy rental properties and you have a property manager and you want to keep it in your IRA, maybe that works for you.
Mhm.
Because now you're splitting it 25, 25, 25, and there's not a whole lot of loss on that. Maybe, I don't know. Guess it depends on how many you have, right, Larry?
Yeah, and also
Yeah.
I think outside from the tax perspective is also like where you are in life person. 'Cause I always like take a holistic view where it's like, okay,
Yeah.
are you using the cash flow from that investment to, let's just
True.
say, hey, you want to get into mortgage notes. All right,
Yeah.
you're not gonna be able to get a lot of losses of it, but you may be using one to pay a cell phone bill. Just throwing out an example.
Yeah. Yeah.
And it was like, okay, yeah, we want to leave that outside of the retirement account because you want to be able to benefit that income to pay that bill because you're trying to leverage your passive
Yeah.
investments to pay off your bills. So you may be building your passive income to replace your
Absolutely.
W-2 income. So that's a outside the mortgage notes, for example, is more tax advantageous than having W-2 income, but it's just
Yeah.
you're just kind of building it along the way. You may still
Yeah.
few in your retirement account to build that as well, but you may be still building cash flow for yourself personally.
Yeah. And I like your perspective of like, where are you at in life?
Right.
What do you need? Do you need immediate passive income? Is this something you can wait for 20 years? Like, where are you at?
Right.
Because all those different perspectives need to be taken into consideration. Um, so talk to me a little bit about, we'll kind of run into that. Like, where do you see, or how do you see retirement as like a potential legacy opportunity? Like, what should you prepare for when you're younger? I'll give you an example. Let's say I'm 30 years old. I have two children now. Probably need all the passive income I can get at that point, right? Um, This is our reality. We go through life changes, right? But let's say you're 30 years old at the time, but you're making decent money. Maybe both income producers are doing well, 2 children. How do you prepare for the future? Maybe beyond you. Do you start doing that at 30? Do you do it at 20? Do you start it at 40, 50, 60? Like, at what point do your retirement accounts become, a legacy? And how do you create it?
Yeah, it's especially now as because the IUL is starting to become very popular for a lot of
Yeah.
people. It's like so they're balancing that with retirement accounts. But it's like, hey, well, why not start now? Like say, especially if you're generating income that you can like put into those different buckets.
Yeah.
Like hey, it's not so much as an age aspect for me, it's like once again, okay,
Mhm.
what bad debt needs to be paid off? Okay,
Yeah.
you start getting that stuff wiped out. I don't care what age you are in the way the country is now. A lot of people just in different forms of debt, especially student loan debt. It was like, okay, let's just start getting that stuff paid off along
Yeah.
the way, and then let's kind of take a look at okay, what excess is there once bills and the basics of life are covered. And then okay, then we got some money to put into the retirement accounts there. So like it doesn't have you don't have to max out the 7,000 every year. It's just
Yeah.
kind of like slowly, once again, steak knives,
Yeah.
kind of slowly, kind of just chip at it, and then have those years. Okay, cool. We got a little bit more. So now you actually have like your budget in place that what you've been paying for. You've been tracking your expenses. We know where the income is coming in. 'Cause I think a lot of people just don't know where the money's coming in from. If it's especially if it's not
Yeah.
W two, I mean, how much of it's going out, especially if you got a whole bunch of subscriptions and stuff. So
Yeah.
like, okay, we gotta get a handle on that stuff, and then we can get the debt out the way, find the investments, but then also okay, we can put money towards the future as well.
Yeah. Sounds like a little therapy session there. Let's break down where your debt's at first. Because you can't, it's tough to give advice, professional advice, if you really don't know the full scope of the picture of what's going on with the client. Where do you start with your clients? Like, if I were to call you today, Carrie Cook picks up the phone and calls and says, you know what, I need a new tax professional, and can you help me out? Where do you take that conversation with Carrie?
Yeah, it's my job as the professional to really get an understanding of where you are. In the sense of hey, not just like we'll get to where you're trying to go. Like everyone's calling me, I know you want to save on taxes. That's obvious. Like
That's a
I don't
given. Yeah.
really, but like, hey, where are the kids at? And like, okay, how's okay, where are they at in the college projections for that
Hmm.
standpoint? Or are they even going to college? And then are you
Yeah.
is there a 529 plan in place? If it is or isn't, I'm not really making any judgments. It's just really getting an understanding
Yeah.
of the holistic view of it because I could just sit here and just shoot out tax strategies to you for an hour and forever if you're not mentally in position to do the work that's needed to comply for that tax strategy, you're not going to do it, or you're not going
Yeah.
to qualify, and then you're at risk of if you are audited, all that stuff is going to get wiped out, and you're getting penalties and interest. So it's like, so
Yeah.
where are you? Like, where are you at? Where are you capable of doing? Um, even from like a fine. I tell people like tax strategy is gonna cost you time and money
Yes.
wherever anyone try to sell to you is going to cost you time and money, and you got to make sure that the tax savings outweigh the financial costs and the time cost that's going to create for you. Same thing with
Absolutely.
people that was like buying all these like G-Wagons when percent bonus and first came out and combined that with Section 179. It was like, okay, well, now your business property taxes have gone up on this thing, and the repairs and maintenance on this thing is still it's
Was it worth it?
but
Yeah.
you got this year one deduction, and
Yep.
you gotta keep it business use or just trash the thing because you can't resell it because you gotta pay all that back. So it's like once
Yeah.
again, is it really worth it? Like is your business even profitable enough to even buy that stuff? do you even
Yeah.
around that much? Do you even need it to show it off? And who cares what you're even driving? That's just I'm not really a car person, so so
Yeah. That's okay.
who you flexing on at that point? And
Yeah.
you could just get this 1 year tax benefit, but then have to deal with this financial headache year after year after
Year
year.
after year. Yeah. How many years do you have to hold on to that? How
Well,
many years you holding on to the G-Wagon?
you got the 5 years, so it's like you try to get to that point, but then it's like, hey, you really want to avoid like how you're disposing of. You got to be cautious of how you're disposing of it, because you may have to deal with the recapture if you
Yeah.
are selling at any given point because your bases basically are at zero. So like,
Yeah.
okay, that clawback is going to get you. So then it's like, hey, are you then uh, just keeping it around and
Yeah.
possibly buying something new, or or I know some clients it just happens to like break down and it's never used again. It just kind of
They
sits there.
machete it? Is that what you're saying?
Okay.
You know, you're throwing knives at it like, nope, 5 years, 5 more knives. And they're like, no, throw in the machete. How do I get rid of this thing? But
Yes.
you're 100% correct. I mean, we see the shiny penny, right? We're like, year one, we get this huge tax write-off. Woo! Okay, but you got to ride it out. You absolutely have to ride that out.
Yep.
That's wild. And we run into those things often. And you know, especially with the younger generation, even any generation for that matter. I know I'm trying to focus on the younger, but it's hard. Thank you for watching The Preferred Way. Next week, we're going to continue our conversation with Larry about how the younger generation can continue to use self-directed IRAs. Don't forget to like, comment, and subscribe. We'll see you next time.
Thanks for joining us for another episode where retirement savers meet alternative investments. Can't wait for the next episode to learn more? Visit our website at preferredtrustcompany.com.